A warm welcome to Market Pulse by SE Securities and Daily FT. As usual, our effort is to help you to get a better pulse about the equity markets of Sri Lanka. I'm Dilusha Gamage, representing SE Securities, and my co-host is Mr. Nista Kazim, the Chief Editor of Daily FT. And it is paramount to have an unbiased and balanced view about the equity markets for you to get a better idea about the markets and also make informed investment decisions about the market. So to do that, to help you to do that, we are having 5 stockbroker companies on one stage today for you to help make decisions on the market. Let me introduce the panel. On my right-hand side, Mahesh Udugampala, the Head of Research of SoftLogic Stockbrokers. Then Dimantha Matthew, Head of Research, First Capital. Hasita Lienage, Head of Research, Capital Trust. And Shehan Kure, Director, Head of Research, Equity Stockbrokers. And Salia Gamagedara, AGM Sales of SE Securities. To start off and lay the foundation, Mahesh, shall we start with the conversation with the current market valuations? Is it attractive to invest in the market, or you think that it should get more discounted? What is your view on the market?
Thanks, Dilusha, and thanks for inviting me for this discussion. So when it comes to valuations, what we need to understand is that markets always look at the future potential of earnings and then get adjusted. And that's not only in Sri Lanka, worldwide that is happening. I think over the last couple of weeks, that has been happening in the Sri Lankan Stock Exchange as well, because with the announcement in taxes, we have seen a significant reduction in the capital, in the market cap of the companies. And the beauty of the market is basically that markets usually overreact. Most of the time, it overreacts, and which is why we see investment opportunities in the market. And now, when it comes to valuations, what we see is that the current market is trading at 5 times, and over the last couple of months, we have seen this trading at 4 to 5 times. And I think it's understandable that investors are valuing this market at around 4 to 5 times because of the current economic situation in the country. Of course, we have seen one of the worst crises in the history of Sri Lanka, and which is why we have seen from starting April this year till around July, we have seen the market trading at these levels. However, that's the past. However, right now, what we see is we are going to see a recovery. And if you look at other countries which has gone through a similar crisis and which has gone to the IMF to seek assistance, have seen a major recovery in their economic indicators, as well as their markets have re-rated upwards from after following the first tranche. And we would see other multilateral parties also coming into giving us or extending credit to Sri Lanka, and that's a recovery cycle. So when it comes to valuations, we we have seen the market trading at around over 11 times. If you take the last 10-year average or 5-year average, it's over 11 times. But right now it's at 5 times. And if we are expecting a recovery going forward, similar to what we have seen in the other markets, we expect there needs to be a re-rating of the multiple upwards, at least to 7-8 times. Now, in terms of corporate earnings, this year we are expecting about corporate earnings to move up by about 30% year on year. In the first half, almost we have seen about 80% increase in the first half. But towards the second half, we're expecting there needs to be a slowdown. And for 2023, with the taxes that have been introduced, with the reduction in consumption, and also I think most of the companies that have uh, made very high margins on certain products probably will get normalized over the next year, because we are looking at a recovery cycle. So in that case, we can expect a 20 to 25% reduction in earnings for the next year. However, if we still value the market at around 7 to 8 times, we are looking at about 15 to 20% gain from the current levels, which is a good gain when it comes to ASPI. So I think the valuations are pretty cheap, and if we are expecting a recovery cycle, we are at the start of the recovery cycle. We have gone to the IMF. The staff level agreement has already been done, and probably the next step would be to get the creditor assurances, the financial assurances from the creditors, and we can expect the first tranche to come in the first quarter. Of course, there are uncertainties. We might see delays in certain debt restructuring to getting credit assurances, and also there are certain uncertainties in terms of the budget which is around the corner, and also there could be uncertainties in the first half of the year. Maybe we might see an election coming in, but when we look at other markets, we have seen a recovery, and also we have seen the multiple re-rating with the recovery. So I think in terms of valuations, it's cheap, and probably we might see a recovery in the first half of the next year. That's my view on the valuations.
Yeah, thank you. Dimant, I'll move on to you. What are the current and potential factors that can impact the market positively in the context of what Mahesh mentioned? What factors do you think will benefit the market going forward?
Thanks for the opportunity. So, starting off where Mahesh stopped, basically, I also think that IMF is going to be definitely a key factor for the market, and I have sort of like the same periods that Mahesh was looking at around the first quarter of this year for the IMF board level agreement to come. So the governor had clearly mentioned that there are obviously a number of preconditions to be satisfied for the IMF, but with that, we believe that around January level there could be IMF board level coming in. Of course, we have to get the debt restructuring going. Basically, we have to get the creditors onto the negotiation table, and once the board level comes in, then we will go into negotiations into restructuring. And so after the first tranche, probably in between the first tranche and second tranche, we will have to probably complete the debt restructuring, which is not going to be that easy as well. So next year is going to be a bit of a volatile year. So in addition to the IMF, I would say overall economy-wise, we are sort of a bit positive. So right now you have the taxes coming in. Of course, that's going to negatively affect the corporates, but we need to take a look at it on a economic perspective. So what we think is right now the purchasing power of consumers have significantly declined. taxes coming in, uh, tax revenue to GDP of the government is likely to improve, and with that, we will likely have better or lesser pressure from the government borrowing side, which is likely to sort of reduce interest rates. So declining interest rate environment is another positive for corporates, which will reduce the finance cost. Obviously, now we are looking at somewhere around the 25 to 30% mark for the AWPLR for the fourth quarter. And so in addition to reducing finance cost, over a 3 to 4 year period, we believe that the buying power of consumers are likely to come back into the market. So if you take the first half of next year, we are likely to see a significant decline in inflation, which will positively impact consumers. And with it also, there's likely to be wage hikes coming in December period and March period. So with that, the real purchasing power of the consumers are likely to move out towards, especially towards the second half of the year. And with it, the gradual increase continuously is what we are looking at. So all those factors is likely to positively impact the market, and of course there's likely to be volatility towards the first half of next year, and of course the last quarter of this year, because the corporates are likely to be negatively impacted because of the tax that has been introduced, and the economy sort of bottoming out. We think the economy is bottoming out around the current period and is likely to start recovering towards the first half of next year. So all that is likely to positively affect the corporates with purchasing power coming back on ground towards the second half of next year, which will positively impact the GDP as well.
Thank you.
Thanks, Dimanta. So with that positive impacts, and Hasita, there are negative impacts as well. So especially the treasury bill rates, it's trading at 33% at the moment. So in this kind of a situation, equity markets, is it still attractive? Or what is your view on that?
Very interesting question. To answer that, I think we need to understand tax reforms and the implications on different asset classes. Firstly, now on fixed income, government securities or fixed deposits, for example, assuming they're yielding 33% nominal interest rate, there is a 5% withholding tax applicable as source, which is non-final, which means the interest income feeds into your interest income computation, sorry, your tax computation, and you're liable to pay taxes up to 36%. So, putting things into perspective, assuming you have a fixed income investment of 10 million rupees, yielding at 33% interest rate, then basically you're liable to pay 36% interest and 36% income tax on the interest earned. So looking at the nominal interest rate of 33%, net of taxes of 36% will result in a net rate of around 21%. So you need to look at both the nominal interest rates of 33 as well as the 21% net of taxes. At the same time, as mentioned before, inflation is around 69.8%. So net of so you're looking at the real interest on fixed income, a net of taxes around negative 49%. So you need to look at these elements when you're looking at fixed income, for example. But the other end, equities, as a result of these tax reforms, is one of the most efficient asset classes. There's only a 15% withholding tax on dividend income. Your returns, investment returns, don't feed into your personal income tax calculation, and there's no capital gains tax. So, as a efficient asset class, equities is very attractive. At the same time, select companies historical earnings, as well as in terms of projections, they keep exceeding projections in an inflationary environment. So valuations are very attractive. Between certain counters are trading between 2 and 3 times, for example. So given the attractive labor market, as well as the nature of equity, there could be a clear upside potential for the market rated where the potential. So all in all, given the volatility, equity could be interesting, very attractive, and probably very regular better.
To probably about 30%. And there are some companies which benefits from the upcoming budget as well. So what's your view on the expenditure side of this?
Yeah, so on the corporate income tax became a shock to some, where some companies, for example, export companies that were paying 14% now have to pay 30%. Manufacturing companies that were paying 18% now have to pay 30%. So yes, there was a significant shift in corporate taxes. But when you're looking at the financial impact on the companies and companies' earnings, we need to look at the net effect. So these changes, if they are passed, then will kick in from 1st of October. So for the next 6 months, these companies, the impact, as per our calculations, net earnings will reduce by around 4 to 7% on these companies as a result of the increase in taxes. For example, the market which peaked, I think recently peaked at around 10,100 points mid-September, came down by 15.5% as a result of tax changes mid-October. So the decline of these counters were around 20%, which really didn't tally with the decline in earnings forecasted. So the market did overreact to them. So we need to understand the financial impacts, and then if the valuations did improve as a result of the overreaction, then that's an opportunity for investors to enter such companies and stocks.
Look at what should be your overall allocation into equities and how much in cash, short-term securities and long-term. So what we recommended earlier this year was that given the high volatility and economic uncertainty and so on, that you should reduce your overall allocation to equities to about 30-40% of your portfolio, and within that portfolio stick to export-oriented companies, dollarized stocks, and stocks that have a high inflation hedge like fuel and food prices and things like that. So I think overall we'll stick to that same narrative. So the benefit of having a high deleveraging your portfolios and having a high cash buffer, or having the bulk of your cash in short term, is that you have liquidity to get into any bargains or strategic investments as and when they come up. But I think given the current valuations of the market, what some of the previous speakers touched on, I think now is we should probably be looking at the long term, especially if there are any stocks which have good potential and valuations less than 3-4 times on PE. I think there's still quite a few that are having good fundamentals, and at 2-3 times on current and forward PEs, then that you should probably take a long-term exposure to those, but retain cash to capitalize on any short-term opportunities as well. And the other is to leverage on any re-rating of the market. So re-rating of the market will largely depend on how interest rates come down from current levels. It may take a bit longer than what we are expecting, because we still expect that inflation on a 12-month trailing basis may still be in like the 20% range for most of next year. So, and given that there's a very high, with the debt default, there's no foreign funding for the budget deficit, so everything has to be funded with the local liquidity. So that may keep interest rates, nominal interest rates at high levels for a while to come.
Okay, thanks, Shahan.
And let's look at the technical perspective of the market now. Salia, now as per the technical analysis, what is your take on the market? Where are we heading?
Thanks, Dilusha. Actually, I want to make 3 points. The number one being that we are in a consolidation, and a consolidation is a period where drama happens. As all the fundamental points were made, there's a lot of drama. And we are at this present moment is consolidating within 3,450 points, but it is narrowing within an ascending line. The number two, for me, by far, is one of the most important points, is that since 1996 to date, only twice the price earnings ratio of the ASI has fallen to 4.4 times and 4.5 times. 4.4 times was in January 2001. 4.5 times was in 2022 July. Now, price earnings ratio itself is not going to be the only ratio. There are many that we take into consideration. But that's a trigger. And whoever is taking that trigger to their opportunity is their responsibility. The number three is that since 2001 December, we are in a bull market with 3 major reversals. The first major reversal was between 2007 and 2008. For 23 months, the market came down by 50.7%. The next being between 2011 and 2020. In that 110 months, the index fell 46.4%. Then came the next major reversal. That was in 2022. From January to April, in a matter of 4 months, the index fell 50.5%. Thereafter, there was a rally making a little over 50%, and the market pulled back into a correction that is where it is right now. All in all, whoever sees the value have the opportunities to invest and trade right now. Those are the 3 points. Thanks.
We have a common question to all our research. What would be the shares that each of you would be recommending? Maybe list of 5 maximum, maybe. Maybe we start from Himanta. What would be the advice to investors?
So, in terms of the overall market, we are actually quite positive on the market, mainly because we are targeting ASP around 10,000 by end of next year. But the thing is, we are looking at a very volatile uptrend, like what you saw over the last 2 to 3 weeks. There's always likely to be volatility because the government is sort of looking for income, and that it will be the same way even next year and even in the upcoming budget. So they'll be always looking at ways of increasing income. So that is not a great place to be. And you have the other factors such as debt restructuring also there. So that could affect positively or negatively, go either way. So all these factors can affect the stocks. Because, for example, the debt restructuring can affect the banks and the finance sector in a bigger way. So, if you take right now, despite the increase in taxation, we are continuing to be very positive on the uh, banking sector. Sorry, continue to be very positive on the export sector. So mainly that is because the export sector with the depreciation plus the economy sort of looking more at exports, and almost all investors putting all their investments into the export segment, we believe that that sector is likely to perform in the long run. In addition to that, we are very positive on the hotel sector. So a number of hotels I can mention, but I would like to stick to the hotel sector as a whole, because all hotels we are extremely positive on, and we believe that that is likely to be the main sector for the next couple of months, with the strong increase in tourist arrivals that we are expecting. In addition to that, we're looking at for the first half of next year, we are very positive on the banking sector and the food sector. Banking sector, why? Mainly because we believe that by around the first 3 or 4 months, or if you take even 5 months, we think there'll be a lot of change that will happening because of the debt restructuring, and we believe that within the first half of the year, Sri Lanka will manage to complete the debt restructuring process. And at the moment, the banking sector is trading at around 0.3 times PE, and with it, after the debt restructuring process is over, we believe that banking sector is likely to be a very, very attractive sector, and we are more positive at the banks that have a very high level of capital, especially the big three banks where the capital adequacy ratios are pretty high. And then the food sector, with the consumer demand likely to increase in the coming year, with the gradual recovery in the economy, we believe that this is going to be a key sector that is likely to be positive, and some of the counters in this sector are also identified as defensive counters. So with the high dividend yield that some of these counters are experiencing, we believe that this is likely to be a key sector to perform in the upcoming year. In addition to that, I forgot to mention one sector we are continuing to be very positive, that is the energy sector. So when you say energy sector, so we are positive on LIOC, LAF Gas. In addition to that, though it's manufacturing, even Chevron Lubricants, which is selling lubricant products, is also identified as a key counter that we are very positive on. So as you can see, there are a number of sectors per se that even in this kind of tough market conditions, that investors can be positive, and they are fundamentally attractive and also have high dividend yield. So overall market may have a lot of volatility, but you can say that these counters are likely to be performing, and fundamentally has the valuations to perform in tough market conditions as well.
Thank you.
Thank you.
Shehan?
So we are also mostly bullish on the export sector. So out of the export companies, based on the current values, we would probably recommend Haley's MGT and Haley's. Then in the conglomerate / hospitality sector, we like Melstar Corp. And then in food, we like CIC and Plantations, generally, we don't like cyclical stocks, but Bukit Dara, because it's a dollarized plantation company, you may want to consider that. We think LIOC below 200 rupees is now at somewhat more fairly valued, depending on how the liberalization process takes place and what would be the long-term market shares. Chevron also, if they have a greater role post liberalization of the fuel sector. So those would be our main stocks, main picks. But as the previous speaker also said, so banking sector is something that we've been looking at since the beginning of the year, but it's difficult to recommend because there's a big overhang in terms of both the debt restructuring and the NPLs with the current recession. So I think this quarter will give us some idea on the NPLs in relation to the current economic environment. So I think the foreign debt restructuring, it's already factored in because we can calculate the exposures and things like that. So what is remaining to figure out is the local debt restructuring, or if and what nature that is in. So we don't, in terms of the local debt, we don't think there'll be haircuts and things per se, but we think that they may have to bring in some sort of yield control to bring the debt into a sustainable level. So probably we'll know how that's going to play out by the end of the year, as the foreign debt restructuring takes place as well. So depending on the outcome of that, then yes, banks are very undervalued. And if the restructuring is going in a positive manner, then banking sector may also be on our list.
Okay, thank you. Mahesh?
Yeah. So in my point of view, as I mentioned earlier also, that we can expect a reduction in earnings for the next year. And even with a reduction in earnings, if we value the market at around 7 or 8 times, we still are looking at a gain of about 15 to 20% on the ASPI. However, given the uncertainties, I would say it's always better to pick the stocks rather than betting on the entire market. So in terms of our recommendations, we are looking at counters, the defensive counters, and the counters counters which are recession proof are the ones that could do well. And also there are certain companies that have taken advantage out of because of this entire economic crisis or the food or the shortages, and these companies can continue to perform well. And also, for example, I hope mentioning the names of the companies would be fine. And for example, a company like Demo, which has changed their structure entirely from automobile to agriculture. Or if we can name a company like CIC, because of the food security concerns, we have seen that company doing extremely well, and that company is now catering into most of the essentials, the healthcare, food, poultry, things like that. So companies which have exposure to these essential stocks are the ones that are going to do well. And even in case if we see major delays in the IMF, or if we see major disruptions in supplies or shortages in raw material to fuel to electricity, still these companies could do well. So apart from that, I think tourism is another sector that we are bullish on, and not all the companies, but certain companies that have exposure to tourism, which are more diversified companies such as John Keells as well as Aitken Spence, are the ones that we recommend from our topics.
Thanks, Mahesh. Haskell?
So let me just initially link my answer to my previous question and answer as well. So with regards to the tax reforms that I mentioned, there are certain counters that were not really impacted in a material manner with regards to the tax reforms. So for example, Expo Lanka, 95% of its revenue is from overseas markets. Only 5% is from Sri Lankan subsidiary. So with the tax impact, there is no real material impact on the group's net earnings. Same with LOLC, for example. 60% of its revenue from overseas markets. Out of the 40%, LOFC will account for 8% of their bottom line. And LOFC, as a result of its merger, has a 46.6 billion deferred tax asset. On top of that, the group has around 47 or 48 billion of carried forward losses. So even though the count has come down maybe 20% or 25%, the net earnings is not really impacted by these tax reforms. So same way, if you look at Bill, for example, again, there is a 26.5 billion carry forward tax loss. So they're not really impacted by these tax reforms, yet the share price has come down by 20-25%. Then you have the counters like LIOC, where it's BOI registered, it's a BOI company, there's a concessionary tax rate of 15%, which will continue. But the market seems to have overreacted and sold down some of these shares, even though the net earnings aren't really impacted in a material manner. So there's a possibility where these counters will bounce back when they keep reporting strong earnings. So that's an opportunity. At the same time, if you look at the manufacturing sector or the building material sector, a subsector of the manufacturing sector, because of the increase in interest rates, the market participants expected a big contraction in volume and profitability. Yes, the volume contraction did happen, where sales volumes might have reduced by 30% for some companies. But if you look at the profitability, the management have been very dynamic, especially monopolistic sectors, where they've kept increasing the GP margins to offset the volume reduction, and they continue to outperform even historical earnings. So as a result, some of these counters are trading at 2 to 3 times earnings, which some of the market participants didn't really expect. So there are opportunities out there for different sectors where, due to misinformation and mispricing, they're quite attractive and should see the trading prices reflect some of the fundamental values.
Thank you. Sandhya?
Yeah, finally, let me highlight a point with regards to the strong hands and the weak hands. As we technicians believe, we firmly believe of support and resistance levels. So as a result of that, strong hands as against the weak hands are very important to understand and recognize. Let me highlight the characteristics of the weak hands. They panic for everything. Whether they are investors or traders, they always act irrationally. That's a part of weak hands. The number 2 is the ones who do not have any money management techniques. They get always caught for forced selling. You need to have your money management techniques. Number 3 are the ones who are going behind social media. They are not the registered investment advisors or qualified research departments. Right? Over the years, we have seen, and now it is increasing, you can listen to social media as long as you have your money management techniques and discipline. That is nothing to do with weak hands. That happens to the strong hands only. So these are the 3 main problems a weak hand is having, right? It can be a person with a lot of experience, but if he doesn't have the money management techniques and get forced sold, he has to think twice and understand why he is trading or investing. Finally, you need to understand whether you are an investor or a trader. Based on the present scenario where we mention about all these factors affecting a lot of attractive valuations, you see, as far as your trading is concerned, with regards to technical analysis, right? If you short this market, you need to understand your return. Otherwise, you have to start accumulating, right? So if you're a trader, have your stop loss, make your money management strong. If you're an investor, become a real value investor, right? A real value investor, look at the present scenario and work forward. When we are working forward, it will be in several years, minimum 3 years. You have to have your return on investment. LIOC gave you 1,440% return from April to September. What happened to you? Think about it. And that's basically what technical analysis is all about. Understanding the proper discipline. Thanks.
Thank you, Salia. And thank you very much, gentlemen, for your thoughts and your advice to the investment community. And at SC Securities and Daily FT, with Market Pulse initiative, we sincerely hope that we were able to give you some kind of guidance for you to make informed investment decisions at the current market conditions. With that, we'd like to conclude this session. Thank you very much. Have a pleasant evening. Thank you.